Yeah, that's. I'm sorry. I apologize. And so.
Be more direct.
Well, I'm trying. I'm trying.
This is a little. Okay.
I was trying to have us sit up here so we could have more of a. Up if you want to. If you want to pull up a chair and sit up here, whatever. So we're all yeah. I mean really. And I can help you. So I'm going to do a quick kind of. Oh, Senator Lesser's here too, which is awesome. Where is
Slip this in the ticket.
yeah, slip it in and you're
Ticket max strip off.
You'll come up here to this podium. Here to ask. And this microphone is.
a little bit more formal than I had anticipated, but nonetheless, thank you everyone for coming. Population that has a specific set of needs and a growing set of needs. An important part of our population who want to be here in Connecticut and to age gracefully and participatorily in the state of Connecticut as much as they can. So it is a pleasure to be here, and I look forward to hearing from you as well.
All right. I'm Anna Dorgazi. I'm the Associate State Director for Advocacy and Outreach at AARP Connecticut. I'm glad you pivoted after you said the phrase aging problem, because we certainly don't think of aging as an issue at AARP. I'm here today because two of the issues that we hear the most about from our members are the cost of long-term care insurance and the cost of prescription medication. So these are two issues that we know have solutions that go beyond what individual folks can take care of for themselves. So we're really looking to the legislature to take some substantive action on these topics in the coming year and in the years to come.
Well, my name is Mike D'Amico. I'm the state representative for the 21st District, which is right next door in Farmington. I am one of Senator Slapp's constituents, so I couldn't say no when he invited me to be here. I'm a member of the Public Health Committee in the legislature. I don't claim to be an expert on any of these issues, but like my colleagues, I'm smart enough to listen to the experts, even though I myself am not an expert. And I'm happy to see some of my constituents and former constituents here in the room today.
So before we open it up, I just want to acknowledge a few people who are in the audience. Councilwoman Beth Carrigan, who is in the back, and Beth, you're welcome if you want to join us up here, but no pressure. But Beth is somewhat of an expert too on long-term care insurance. So I think her perspective at some point this evening would be greatly appreciated. So whenever you're comfortable and want to do that, that'd be great. Sure. And Kate Farrar is here, and she's the executive director of QUELF, which is an advocacy organization that really works hard to benefit women in Connecticut, and has done a lot of great advocacy work on many of these issues. So, anyways, welcome to both of you. If there's anybody else I'm missing, my apologies. So, we don't have a batting order or a lineup, so if anybody wants to begin, and I think we'll get into a lot of the substantive stuff as we go, but again, no political speeches, we'll get right to it. Bob, I saw your hand first, then we'll get over to you, Kevin.
Okay. I just wanted to read something that I sent to the insurance commissioner's office in May of last year, and they told me there was nothing, and there's not, whoops, wait a minute, where's the button? Oh, there's,
You're all set.
okay, anyway, quote, this will take me about a minute to read. In May of 2001, my wife, who's sitting here, purchased a long-term care insurance policy from GE Financial Assurance, which was subsequently switched to Genworth Life Insurance Company in 2006. Following are my yearly payments. From 01 to 07, we paid $36.60 a year. Then in 08 to 011, it was up to $4,060. Then in 12, it was $4,800. And then in 2016, we had to lower our coverage by 50%, and now the premium is $3,900. And then in 17, we paid $4,400, 18, $5,000, 19, over $6,000, and 2020 is scheduled for $6,800. In 2021, scheduled for $7,445. Now, mathematically, I figured this out. In the 18 years we've had this policy, the premium increase has been over 400%, or over 22% per year. We've been notified there will be a 48.46% increase for the 3-year period beginning last year, which the above scheduled payments represent. This represents a financial hardship since we've been retired for, well, over 14 years, my wife 17 years, and we live on Social Security and a fixed pension, and we just find it difficult to understand how the insurance commissioner can let these high increases go on.
Thank you for the question. And again, this is one of the probably top 3 complaints that we receive at the department. The first thing we do as a regulatory agency is we review the state laws, we review the state statutes, and we review the contract. And with these contracts, it does state that, the rates can go up as a group, and they have gone up as a group. Paul Lombardo is very well-versed in this, and he can go through the history of it. But again, at the department, what we want to do is make sure that people understand what their options are. Did the company give you options for reducing your benefits to lower the premium amounts? Okay, and that's things that we can walk through with you as well. And again, as I preface my comments, we don't have very good answers for you from a standpoint of we're going to lower the rates, because again, it goes back to the contract, and that's what guides these issues. But there are options that you have. You can review the policy, look at the benefit levels, and again, when we've looked at people who have had these contracts for 20 years or so, with the inflation protections, the inflation guards on it, the amounts that they have are even above what a daily benefit is going to be, even in Connecticut. So those are things that you can look at to balance those costs. And I always, advise people, make sure you fully understand the benefits that you're getting. Do the calculation. Some of these older policies, it had an unlimited benefit, so you can't even calculate it. But the ones that have $500 a day for 3 years, and for the two of you, you're talking in, over $1 million of coverage. And if you look at the premiums that you paid in those comparisons, the value of the protection you're getting is a great deal. But the bottom line, and this goes to each individual person, it's the affordability. Look at why you purchased it. Was it to protect assets? Was it to, get into the long-term care facility that you'd like rather than one you're assigned to or whatever it may be? Look at that, look at the cost of those facilities, and then make those choices. And again, not what you want to hear, but there are options for you to do.
If it makes sense, I can take 5 minutes to kind of walk you through how we got here. The original pricing that was set for long-term care in the 80s and 90s was not based upon insurance data. Long-term care in the insurance world is extremely new. Plus, it has a very long tail. Claims don't appear until 25, 30 years after the average cohort purchases the product. So there were basic assumptions made. They used general population data. They did not use insurance data. There was no insurance data available. They made assumptions on interest rates. If you go back into the late 80s and early 90s, interest rates were probably double, at times 2.5 or 3 times what they are today. They took probably an assumption of between 6.5% and 7% on interest rate and investment income return. That clearly hasn't been the case for them. I'm not trying to make excuses here. I'm just trying to walk you through where things went wrong. And unfortunately, it's a perfect storm. The other assumption that was made was that there were going to be people that purchased this and then over time would voluntarily lapse the product. Everybody, and again, this isn't just in Connecticut, everybody across the country is purchasing these long-term care policies. They see an absolute need to have this insurance, and they're holding on to their policies. So what the fact is that they generated assumptions that had a lot more people dropping their coverage, which meant that there were going to be fewer people during the claim years to actually qualify for claims. Well, that's not the case. We're down to about 0.5% voluntary assumption right now in the marketplace for new products that are being sold. The assumption back in the late 80s and early 90s was about 3 to 4% per year. So that's a dramatic difference if you compound that over the years of how many people are still holding on to their policies. The other issue is the length of claim. It was always estimated that the length of claim would be about 1.5, maybe 1.75 years. With the increase in drugs that are being used to maintain people and the new technology to maintain people's lives at the very old ages, and I'm talking about 85, 90, 95, it's prolonging their life, but it's not making them necessarily any healthier, okay? Which means that if you go into claim now versus the expectations 25 years ago, you are living a lot longer in the long-term care benefit claim period. So the average claim now lasts for about 2.5 years. There are claims that carriers have been paying for over 15 years, and you can guess that that's the Alzheimer's and the dementia patients, okay? They never anticipated paying claims for 10, 11, 12, 15 years. Those Alzheimer's claims are becoming a larger and larger portion of long-term care claims. And again, with the medication that's available and the new technology and the new medication that's coming out, it's extending people's lives. So while everyone likes the idea of extending someone's life for long-term care, especially as Gerard mentioned, many policies have lifetime benefits. And so there's no limit to the benefit. So the other thing I want to make clear is no consumer has done anything wrong other than pay their premium. Okay? You've done what you were asked to do and pay your premium. So we're not going to make excuses. The reality of this is that with all the mentioning of all the assumptions, it was a perfect storm. They missed all of the assumptions. Okay? If they don't get, well, the next step is that when did we find out that these were underpriced? Well, as I mentioned before, if people purchased these in the 80s and 90s, the average age was between 55 and 60. By the time you get to average claim, it's 25 years later. Okay? Now we're in the 2005 to 2010 area where this experience is starting to come to fruition, and all of a sudden there's a sense that this has been significantly underpriced. We had a carrier pen treaty, but I believe it was American Network in Connecticut, that was put into liquidation about 4 years ago. It was a Pennsylvania company, and there was a decent number of pen treaty American Network policyholders in Connecticut. So to the extent that if we don't start allowing rate relief for carriers, we are going to have more and more carriers in the marketplace end up going into liquidation. What happens in liquidation? It goes into a guarantee fund. There's a guarantee fund for each state. Connecticut's guarantee fund has a maximum allowable benefit level of $500,000. So to the extent that you've accumulated through compound inflation benefit amounts that exceed $500,000, if your company goes into liquidation, you get an immediate haircut of your benefits. You have no choice, because the most you're going to get out of the guarantee fund is $500,000. That's the first thing. The second thing is you're going to still be susceptible to rate increases. Okay? The rate increases don't stop. Penn Treaty, in fact, in Connecticut had a 71% approved rate increase while it was in liquidation. Okay? So the other aspect of this is, we've heard this before, just let them go into liquidation. Okay? Every liquidation that occurs, yes, it's funded by the guarantee fund, but taxpayers fund, they do the bailout for the liquidations. The industry, all health and life companies get assessed for the liquidation, but then they get a tax credit for the assessment, which then ends up getting funded by the taxpayers. So these are the reasons why we work so hard to make sure that we don't have any more insolvencies. Yes, it's difficult. We don't get any enjoyment at all about approving increase after increase after increase. Okay? This is a national issue, as I mentioned before. There is certainly an inequity across the country. There are some states that have approved a lot more of a rate increase level, believe it or not, than Connecticut. And there's many states that have approved a lot less. The problem is when it goes into liquidation, liquidation is going to equal that out. They're going to level that out. So to the extent that a state hasn't approved rate increases in the past, it's going to get multiplied tenfold for the liquidation. Sir, to your point on Genworth, we are probably middle of the road or maybe a little bit higher on average across the country, but there are states that have approved a lot more and there are states that have approved a lot less than what we've approved for Genworth specifically. With regard to multiple rate increases, there is a statutory requirement now that any increase that we approve of more than 20% needs to be spread over 3 years. So that's why you're seeing rate increases that are generated over a 3-year period. In the future, what's happening is the NAIC, the National Association of Insurance Commissioners, is working feverishly. It's their number one priority is long-term care. To A, try to make sure that we don't have any more insolvencies, and B, try to come up with real live solutions and options for you, the consumer. We are working on that. There's an executive task force that the commissioners are heavily involved with. There's work streams that I am personally involved with. I'm the chair of the pricing subgroup for the long-term care, so we're extremely involved in the entire process. I'm also involved in the cash flow and asset adequacy and reserve adequacy testing for all the companies across the country, with about 3 or 4 other actuaries. So we are very, very engaged in this. It's an extremely important aspect of what a lot of my time is spent doing now. Again, we are working feverishly so we don't have any more insolvencies, so that they're there and available to make sure that they make good and pay your claims when you do go into claim. We are looking at different options. Reduced benefit options are obviously something that we are looking at. We want to make sure that it's a fair option for consumers. There's other options that are being discussed that I can't, it's been regulator to regulator only, that I can't discuss now, but we are working on things to make things better for consumers throughout this process. So I'm sorry I took more than 5 minutes, but that's kind of a background from Sue.
And thank you for that very thorough response. I don't have a long-term care insurance policy, and I was getting frustrated just listening to the history of it. It feels like, and I'm not accusing any particular, it feels like a Ponzi scheme. And to me anyway, and I'd love to get your reaction, but in the sense that the business model depends on people dropping after they have all these sunk costs in. And if that's your business model and enough people aren't dropping, how do you get more people to drop, right? Or to or to lower your benefits. So again, I don't have long-term care insurance. Maybe I should, I don't know, but it's wow. And I haven't had it explained like that necessarily, but the business model for people to have it for a while, put the money into it, and then drop it so they pocket the money, never have to pay out, that kind of blows my mind. I don't know if you have anything you want to add or anybody else.
Well,
this won't shut off, so.
I think. Okay, we'll make it work. No, I think, well, thank you, Paul, for that explanation. For those of you who don't know, Paul is he is in charge of the division at the Connecticut Insurance Department, but in many ways is the top regulator of long-term care policies in the country. Connecticut occupies a special place at the National Association of Insurance Commissioners. And so, although this is an immensely frustrating situation for the reasons we've heard just a minute ago, we are at a place where we actually have immense expertise in our own insurance department. And the question is, what can we do to provide relief? And this is something that Senator Slapp and I are deeply concerned about, is what can we do to provide relief to folks? The bright, shiny object out there is, well, we could just simply say, we could pass a law, you cannot raise rates. But then the question is, then what? And that I think is what Paul got into. My question though is just making sure that there's going to be light at the end of the tunnel, right? We've seen these increases. You went through the history over the last few years. Well, what's going to happen the next few years? What's going to happen at that point? Or are we going to keep seeing double-digit increases every single year? Because that, however intolerable our past experiences, it would be worse if that continues going forward.
Yeah, again, unfortunately, I don't have any good answer for that. We are not at the peak of claims for carriers at this point. The average age of some of the carriers that have been in the market the longest is about 84 or 85. Again, people are living longer. The 80 is the new 70, 70 is the new 60. People are eating healthier, exercising, and that's all great. But it's just allowing you to get to the older ages where we would call it the sweet spot for claims, 85, 90, 95. And the problem with that is we don't have enough experience data at 90 and 95. It's the same issue that we had where we didn't have enough claim data at 85. So to answer the senator's question, I don't know what the next 5 to 10 years portrays for your older legacy business for long-term care as far as claims go and rate increases. Carriers do experience studies every 2 to 3 years. They come out with new studies, and unfortunately the picture gets worse and worse and worse. Interest rates started to pop up a little bit, if you remember, about a year ago, and there was some thought that we would get a little bit more steam behind interest rates and have interest rates rise a little bit. That would significantly help the long-term care business and the return on their money. As quickly as they went up, they've come back down. So you can forget about that right now, which is unfortunate. I can tell you, and again, this is not any solace and it's not an explanation of anything. New products out there today, if you were to buy a new product at your original issue age, the premium is about 5 times, 6 times what the premium that you initially paid for in your product. So the new products today are using all of the experience that we have and setting much more conservative. As I mentioned before, the voluntary lapse is at about 50 basis points or 0.5%. They're no longer expecting people to drop their policies. The other interesting thing that we are seeing is that when people are offered different reduced benefit options, so that essentially allows you to keep the premium at the same level that you're at, not incurring another rate increase, but lowering your benefits to a certain level that equates to the increase. Very few people are taking up on the reduced benefit option. They're holding on to the absolute dollar value of their policy that they've accumulated. To Gerard's point, if you have lifetime benefits and you have a 5% inflation product and you've been paying in for 25 or 30 years, you've accumulated a significant daily benefit amount that may, by any standard, exceed any nursing home stay in Connecticut. We would recommend that you sit down with your financial advisor to review your long-term care benefits on a regular basis to determine if at some point you and your advisor feel as though you have enough long-term care insurance that you've accrued. These reduced benefit options allow you to do many things, one of which is to get rid of your lifetime policy and reduce it to maybe a 5-year maximum, or to take some of these options that don't inflate your benefit as high as 5% anymore, maybe 3%, maybe something lower. You don't have to pay an increase in premium. Your benefit just won't inflate as much as it has in the past. There was an overestimation of what nursing home costs would, on an annual basis, have annual inflation for. We are finding out now that annual inflation for nursing home stays is about 3%. Across the country, the partnership plans, I don't know if anybody has a partnership plan here, but the standard requirement was that you had to have a 5% compound inflation benefit because the belief was that the nursing homes were going to inflate by that amount. The realization is that they're not. They're about 3%. So the statute now and partnership now only requires an annual increase of 3% per year. So those are the types of things that we'd like you to think about, at least with your advisors, but it is a very personal decision.
So, you know, from the perspective of an advocate on these issues, it's really, I can hear your frustration. I certainly can. And, you know, the problem here is that we have an intersection in this very difficult relationship that each of you have with your long-term insurance provider. The intersection of an algorithm and algorithms at the hands of an insurance company versus the decisions about quality of life, length of life, quality of care. And the algorithm is going to be ruthlessly efficient in ensuring that either the company remains solvent or it increases your prices, not necessarily taking into account those three aspects that are so deeply ingrained into what you're thinking about in your long-term planning. So the low-hanging fruit, of course, is to require our agencies to be much more vigilant about those increases. The other low-hanging fruit might be with the consequences that would bring of freezing rates. But deeper in the tree are the difficult policy decisions that have to start with the decision that we can't keep our medical costs going up. We have to bring doctors to the table. We can't keep our long-term care costs going up. We have to think of the quality of life of our residents first, and the decisions need to flow from that decision. And so when I hear the troubles that insurance companies are having in keeping solvent, and oh, by the way, take a reduced benefit to keep us from going insolvent so that we can continue to give you less, that to me is not a solution.
Senator Slapp, I'm sorry, I don't know your name. I don't want to be disrespectful, so I'll just address you. I got to say, your figures are wrong. You talked about not over 20% net increase of 20% over 3 years. You spread it out. One policy right here went up 40% in 1 year. The two policies that my wife and I have will have gone up close to 100% if you use a baseline of 2018. Now, insurance companies have problems, and you've outlined them. You said you weren't excuses, just explanations. They sounded like excuses to me. But in any event, I think the key question is this. We want companies to be able to give us long-term care. We want to pay for long-term care. What level of profit do you allow? That's the question.
Yeah, I just want to clarify, it is not a 20% cap per year. What the statute says is that if we approve an increase of more than 20%, so if we approve a 60% increase, that 60% has to be spread over a 3-year period. Any increase more than 20% has to be spread over 3 years. So I apologize for not being as clear on that particular issue. As far as profit goes, there are statutory requirements that every long-term care carrier in the individual market over the lifetime of the policy, and this is important, over the lifetime of the policy, has to return 60 cents in benefits of every dollar in premium. Okay? That's a statutory requirement. On the group side, it's 65 cents of every dollar. Okay? All of our long-term care rate filings that we receive, review, and make decisions on are all on our website. And if you have an inclination to take a look at them, there's an executive summary, there's a full disposition, which are the facts of the filing, the department's analysis, and our final decision. Many of those filings indicate that carriers have already exceeded the lifetime statutory requirements. Okay? There's Genworth policies that have already exceeded 80 to 90%. What that means is they're already paying out 80 to 90 cents of every dollar in premium. And if you look at the projections, they're projected to be well north of 100%. And what that means is they're going to be paying out more benefits than they are in receiving claims. So to the extent that there's profit, the original pricing probably had about a 3 to 4% profit margin in it. I can tell you right now that there's a number of companies that are not making any money on long-term care. I don't have an exact count of every single long-term care company, but again, the projections indicate, and what we've experienced, many policies have experienced, they've already exceeded the statutory requirements. Some of them are projected, many of them are projected to pay out more than they're receiving in money. And so, hence, we're sitting here with a situation that they're paying out more in benefits than they're expected to see in premiums. One point I do want to make is, there's a question about, well, can't they take money that they're earning from other lines of business. And there are a number of carriers, the large carriers, the John Hancocks, the Unums, that have different lines of business. And we are asking them, we meaning the NAIC and regulators, are asking them to increase their reserves, not just through premium increases, but taking money from other products and using that to bolster their long-term care benefits. There's a handful of companies out there that right now their total long-term care reserves is a total of all their reserves for all of their products is about 10% right now. In 5 years, long-term care reserves are expected to be 60% of all of their reserves. Long-term care is growing and the liability is growing exponentially. There are carriers out there that have just been in the business of long-term care. They do not have any other line of business to access funds from. So when we look at this, we're looking at all facets of it. One thing we are doing at the national level is making sure that if somebody drops their policy through a non-forfeiture benefit, reduces their benefit options, we're making sure that the money that gets released for that liability stays with the long-term care product in order to help pay claims, future claims. So yes, we are asking carriers to increase their reserves. Unum just increased their reserves a couple years ago by $300 or $400 million. That wasn't through rate increases. That was a one-time hit. So we are asking them to feel some of the pain as well, to pull money from their capital and surplus. Some companies don't have the capital and surplus to pull from. And again, I know it sounds, sir, and I don't make any excuses. It sounds like excuses, but these are facts with what the numbers that we have. And again, we have no problem going through rate filings with you. If you have the ability and want to look at that, and you're having trouble navigating our website, you can reach out to Gerard's folks, and we can help you through that as well.
All right.
One thing I just want to add, if you don't mind, is, we do get a lot of calls on this, and if you look, I think the number was 120 at one point of long-term care insurance companies. It's down to 12, and I think only 5 or 6 are actively writing. So it's not that the companies are, taking the money and heading for the hills. This is not profitable for those companies, and the numbers of companies that are in the business shows.
So we have two panelists who haven't jumped in yet. If you want to, Ann or Representative D'Amico, and then I do want to make sure maybe we can speed up our end of it so we can make sure that we get to hear from all of you as well. But do you have anything you guys want to add?
All right. Oh, wow, 2 all of a sudden. Okay. So I guess I'm also in the same sort of, fortunate position that Stephen is in, where I don't necessarily have to have the solution, but can speak more from the consumer perspective. And we know with other insurance products, when there's an excess that insurance companies are taking in, they don't share that with us. They keep their profits. They're not, sending us extra money that they have at the end of the year. And I think it just seems very unfair that at a time when, by everyone's admission, that the consumer made no wrong choices here, but the consumers are being asked to account for these bad calculations, these bad decisions on behalf of the insurance industry. I think one thing that we can do sort of as a state beyond just this insurance question is continuing the state's attention and investment in home and community-based services. You'd mentioned the cost of care in Connecticut and how do we address the cost of care. I think the average nursing home stay annually in Connecticut is $169,000 a year. So what can we be doing to look at that cost, to say, why is it so much money to receive this level of care? And are people who are in nursing home facilities, is that the appropriate level of care for them? Could they be receiving care in assisted living facilities? Could they be in their homes? AARP does a lot of survey work around what people want and how they want to be living their life as they age. And for the most part, I think 90% plus of people want to be in their homes. It's where they've spent their life. It's where they have their memories. It's where they have their communities. So are there other investments that the state can be making? We're looking at, I think it's only $66,000 a year for assisted living facilities. It's much cheaper even still to be getting care in homes and communities. And a lot of folks, who might not be at that nursing home level of care could be serviced more happily and more comfortably in their home. And are there investments, small investments that the state could make around transportation, making sure that people can get to their doctor's offices, that we have curb cuts so people can get out and sort of still be in their communities. So that's where, kind of to step outside of the insurance piece specifically, I think the state could be looking to make additional investments, kind of in that macro sense, lighten the load on these insurance companies, and also give people what they want. So that's kind of my general, a couple steps back thought on, where we could go and what we could be looking at.
I don't really have much to add. Just a comment and then a quick question. I guess my comment would be, I'm reminded of about 10 years ago during the banking crisis when the word was basically, well, these banks are too big to fail. So it seems to me now we have a situation where these insurance companies are too ubiquitous to fail, or too entrenched in everybody's lives to fail, which is really unfortunate. But I guess that's where we're at. So I guess my question would be, going forward, are any new companies getting into this business? And if they are they being carefully watched and regulated?
There are no new entrants into the long-term care business. The existing companies that are currently selling want more players in the marketplace, but they just aren't there. Carriers, as a tool for them to use, is to buy reinsurance from reinsurers. Reinsurers will not touch long-term care right now. It is too volatile. The liability is too great. And again, we haven't gotten to the peak of the claims. To your other question about any new products that are being sold, as I mentioned before, those products are 5 and 6 times what it costs the old products in premium. Their assumptions are about as conservative as you can get. And so while we can't guarantee that there won't ever be a rate increase on a new policy that's sold over its lifetime, the likelihood of seeing these significant rate increases has diminished significantly. But it's a much, much, much more expensive product than people originally bought in the 80s and 90s, and even as late as the 2000s, early 2000s.
Now it works. So for Senator Slapp and Representative D'Amico and I, as legislators, I was thinking back to what we heard about the issue of, well, what happens if the insurance fund goes insolvent, and well, the state will have to bail them out. The fact of the matter is, and I think Anna from AARP alluded to this, the cost of long-term care doesn't go away if people don't have long-term care insurance. People are going to access long-term care in Connecticut, regardless of whether or not they have insurance, whether or not they can afford their insurance policies. It just means that the cost may shift. It may shift onto the backs of taxpayers. It's going to shift elsewhere in the system. And my big frustration looking at some of the national efforts, the Affordable Care Act did wonderful things, but one of the things that it didn't do adequately was address this crisis in long-term care. We have to figure out, as a society, as a rapidly aging state, as a rapidly aging country, how are we going to pay for this? And if we don't address that, we're going to have these products that are badly designed, as we find out, at least the original long-term care products were. Hopefully the new ones will not have that issue. But But we're going to have this problem, and we're going to have an issue where people are just going to roll the dice and find out what's going to happen if I don't have the coverage. And the answer is somebody's going to pay for it, and likely, probably more likely than not, it's going to be the taxpayers via Medicaid or via some other system.
So why don't we give you all an opportunity, because we've been talking a lot. So if anybody does want to come up and share their, yeah, go ahead, sir. And we'll try to get as many people an opportunity to talk as we can.
Got a bunch of things here to talk about. I think you just hit on one of the items I wanted to chat about. I have a long-term care policy. I had I got maybe 30 years ago, and it was relatively decently priced then. It was with Genworth at the time. Or actually, Metropolitan then sold to Genworth. What is your ratio of long-term care policyholders in Connecticut compared to those that are going to rely on asset forfeiture, their homes, to be on Medicare or Medicaid, or stay at home? Is it 20-80, 80-20? Any idea?
Yeah, in general terms, private long-term care insurance pays for a very, very small piece of the entire pie for long-term care expenses.
No, you misunderstand my question. For people, how many people, if you tally them all up, have a long-term care policy versus throwing the dice, I'm going to be dead, or I'm not going to need it,
right.
or I'm going to have the state take care of it,
very,
Medicaid, or they're going to take my house?
I think the pie chart we saw at a presentation was maybe a couple % of the people in this state have private long-term care insurance, and the bulk of who pays for long-term care is, as the senator said, the state Medicaid program and the federal Medicaid program. So the bulk,
that's what I thought.
Over 90%, 95%.
So this is really a major state problem, and not just one of people lacking long-term care or affordability thereof. After playing around with this and researching this for a couple of years, some of the problems I see, you got too many people's fingers in the pie. You got 50 states in the USA. Each state has their own insurance commissioner, their own insurance commission. They all have different, disparate views, different customers, whether they be the policyholders, the insurance companies, the reinsurers, or whoever. They're all pulling at you guys. Why doesn't somebody just get together and make it a federal program like they did with Medicare or with the Affordable Care Act? I mean, you guys are just bouncing around, I don't know how often you guys meet on a national level, but it just strikes me as too many people are just coming up with something maybe for their own constituents. And I think Connecticut's done a halfway decent job. I know that Mike was sharing with me some information about the Genworth premium increase. I'll stick up for the insurance commissioner. They wanted more than twice as much than the insurance commissioner allowed them to go for the price increase. In other words, they actually wanted to go 140%, and you only allowed them a 40% increase or something like that. So, that's happening. It's helping to control the cost for us. But this is a national problem. That it's good that you're doing something, but come on, kick your senators, your Congress people, kick them in the butt. Don't take it all on yourself. You're not going to get anywhere. There's too many. There's 50 states with 50 different views of how to solve this problem. And these companies are working across multitudes of states trying to figure out your particular insurance laws and then Tennessee's particular insurance laws. That increases their burden of work, their operations costs by, who knows, 20, 30%. You got to reduce their operational expenses. Another issue is with, I pick a bone with the SEC. Don't know how many people that have Genworth policies know this, but when GE was finagling around with their financial junk and they spun Genworth off, they didn't give GE the assets for your policy. GE promised they would bank it, and when you needed it, GE would be there and give them the money to pay for your long-term care. So they started this company up like a shell game. They didn't have any assets. And maybe that's why they're claiming now, oh, we have like this 80% payout ratio on premium dollars, because they don't have any premium, or they don't have any assets to really pull from. It's still sitting in GE's pockets as far as I know. And now there's a company called Athena who's interested in the GE long-term care policy insurance assets. Then there's another one, a Chinese company who wants the assets. Why isn't anybody stopping this stuff or controlling it? I don't get it. So you really need a more cross-functional team of regulators, insurance commissioners, forming some kind of national insurance program. You've got the SEC that ought to be looking at how these companies are formed, looking at the policies, making sure that they're structured properly. It's a shame we're in this mess in the first place. You know, the Genworth policies, like many others, have that special clause. It says we have the right to do anything with these policies that we want, including terminate them at any time. Thank you. After paying in it for like 40 years, they're going to terminate it. I mean, that's something that if I was on some kind of company or some kind of government panel that like the SEC, and a company was starting to do business like that, I would say, excuse me, what are you trying to do here? And as a retiree from GE, I worked there 30 years, promised me, oh, we'll take care of you in your retirement, here's your medical, we'll take care of all that. A year after I was eligible for my retirement benefits, they terminated the medical program for all the retirees. Well, thank you very much, 30 years down the drain. But we're covered by ERISA, they say. What does ERISA do? You look into those laws, and, oh, well, we say we allow you to read their documents of the program. That's all ERISA does. That's a federal program. I don't know how we let these characters, these government officials take care of do this stuff. This is nuts. And I was helping a young woman several years ago try to understand the long-term care market, and I came across an agent that I talked with, and she was promoting this long-term care policy that apparently was Connecticut approved. Do you know anything about this?
Partnership?
Whatever it is. To me, it sounded pretty good because it protected your home assets. Yep. And to me, that sounded like a decent program. So maybe you guys can propose a program that those assets that are held by GE or wherever they're held these days, go take the money. Make sure Genworth gets it, and then make sure that any Genworth policyholders or any other persons in the same boat, that we can pick our accumulated interest for as long as we've held that policy, pick that money up out of that pie, and then put it in your program. Transfer the business. That way, that'll make that particular program much more solvent. Who knows what's going to happen to the GE program? But, you know, maybe they'll understand they have to limit their salaries to their executives. Maybe they have to limit their profit sharing to their shareholders. I don't know. But it would be nice to have some kind of portability built in so that you could pick up what I have accumulated to date and then move it to another company that might do a better job. But as far as the per premium, the percent of the premium dollars going into actual medical benefits, like the ACA, you have the 80-20 rule. It would be nice to see some studies of what's really going on in long-term care, to see if you can make some kind of 70-30 rule, or something that's manageable. I don't know. I know that for folks that have Medigap policies, I did my own study a couple weeks ago where I looked at what my Medigap policies are, my Part D premiums were, the amount I'm paying in for the Part A and Part B, plus the deductibles, and that adds up to what a gold plan under Connecticut's Access Connecticut gold-plated ACA plan is. And I'm retired. You know, why should my cost be, after I've been paying into Medicare for like 30, 40 years, be equal to somebody that's supposed to be getting a benefit under ACA, where 20% of the premiums go to go to operating expenses and company profits, and 80% go to medical care. But when you're retired in a Medigap, it seems flipped. 40% of your premium dollars are actually going. 40% of your premium dollars are going into the insurance company's pockets.
So you raise a lot of great points. You've clearly done your research. So if I could, I'll ask you just to kind of wrap it up, because I do want to make sure that lots of other folks get an opportunity to talk.
One of the solutions is CMS is a company, is a group, Center for Medicare Services. They only charge the federal government 3.5% operating costs to manage all this stuff. So maybe we can just get rid of Medigap for Aarp insurance or Cigna or whatever, and pay these premiums to CMS. Because 40% of those premium dollars, if you look at the CMS costs being 3.5%, those operating expenses are exactly the same in a business as it is with CMS. So you know what Cigna's paying for their operating expenses, 3.5%. They're doing the same job that CMS is doing, getting the codes in, paying the bills, cutting the checks. So you know that they're making a crap ton of money.
Thank you very much, sir. We'll continue the conversation offline. Anyone have any comments?
Thank you. Thank you for your very thoughtful presentation, because it just makes me think of this as this train steams forward on the track toward, all calamity. I think of the train that's running parallel to it, which is the quality of life and the quality of long-term care, and all of the things that are driving costs up while driving quality of care down. Some of the things that we could be doing now, for instance, is improving and professionalizing the care workers that are in your homes, so that you're not told that you're going to get high quality care in your home and all that you're getting is someone who's going to bring a meal to your table but doesn't know what to do if you have a medical issue, doesn't know what to do if you have a fall, doesn't know how to help you get out of your bed so that you don't break your leg. So that's an issue that we could really be looking at now, so that the drivers that get you into high levels of cost can actually be reduced over time, and the cost of providing that care can be reduced over time as well. So as I'm thinking about some of the ships that are moving straight forward into the, driving us to find solutions for the costs of higher term care, I'm also thinking about what are those solutions on the periphery that we can think about now, so that you're living in your homes longer with a higher quality of life, with the right type of supports that you need. We need to be incentivizing those careers that are lower cost at the onset, but are really going to improve quality of life in the long term for everybody.
If you read the long-term care policies, they don't allow you to have in-home care to the degree that might actually save them money if they had a relative come help out from time to time. If you have like a direct relative helping you, they won't pay for anything. So that could possibly be a change to help reduce costs, keep people in their homes longer where they want to be, reduce the benefits that are being provided, but at the same time, to what the gentleman says, increase the quality of life.
Yeah, does anybody else want to approach the podium and comment or question or feedback for us? Are you on your way up? Yes. Okay, and then Judy, you want to go to next? You can go first,
go. I just want to emphasize the points that you were making about home care at home. I cared for my mom who had Alzheimer's at home, and I wouldn't have had it any other way. But the hassles with, I worked full time, and so, getting that help and having people understand that I needed help, that what I was doing was worth something, that I needed help with that too. So that's my.
Okay. To piggyback off of that comment, we know there are a lot of sort of ancillary pieces that we need to be looking at to really strengthen, as Stephen mentioned, kind of this oncoming crisis in the home care workforce. But also we need to look at policies that support family caregivers. Connecticut has 460,000 people that are providing some level of unpaid care for their family members. So how can we incentivize workplaces? I'm very, very lucky at AARP that we have a family caregiving leave policy where I'm able to take a certain amount of time off. My mother's having major surgery on Monday, and my boss said, go, work from the hospital, take her to the appointments, be there. I'm going to work for AARP forever if they'll let me, because that level of benefit, it's good for employees. I see how good that is for my family. And I also recognize that we don't incentivize a lot of workplaces to take that on. We passed paid family and medical leave as a state last year. I'm really hopeful that we'll see benefit in the caregiving space from that policy. But, are we looking at tax credits for caregivers? Are we looking at ways to make sure that some of the same programs, various Medicaid waivers that will allow you to receive those home and community-based services? Are we looking at ways to compensate the family caregivers that are providing that care, that are taking time, and that are doing this work at lower levels of cost and higher levels of comfort for the people receiving care? So again, kind of on those ancillary issues that fit into all of this.
Hi, I'm Bill McDonald, and there's two issues. One, my mother, who's 93, who flunked hospice in September after 14 months on hospice. She was still alive, so she got thrown off hospice. But she's been at my home for 4 years. My sister takes care of her. My mother, because my dad was a World War II vet, has federal long-term care, which was fairly expensive. She was promised everything from soup to nuts. And just as this gentleman said, my sister, who takes care of her, doesn't get paid for her time. And when she first went on, they said, well, can your mother take a fork and get a piece of food from the plate to her mouth? And they said, my sister said, yes, well, then she doesn't qualify. And at the same time, yet my mother was bedridden. She can't shop. She can't do one of those things. So they gave her a very hard time. The caregivers is very important. We have used 4 different agencies trying to find capable, competent, caring people. My sister and I went to Shake Shack and went in there, and the service was impeccable. The people were friendly. The manager came over and said hello. I wrote to the chairman of Shake Shack and said, how do you do that? If you can do that with fast food people, why can't we do the training for people so they can come to the house to do that? You can't find people. I actually copied Warren Buffett. Warren Buffett's office called me back, and this is a national problem, and thinking that the foundation, the Gates Foundation, could look at that an issue because so many of us are going to have to address that. But it's a real serious problem. And my sister is with my mother 24/7. I mean, it's really dedicated. I couldn't do it. I'm the Walmart greeter. I have people come in and say, hi, how are you? But as far as long-term care, I have a Genworth policy that I purchased in 2006. The policy went from 4 years ago from $4,000 a year to $6,500 a year. So the premiums are going up. But the question is there enough money to cover the cost of staying in a nursing home? My mother fell and had to go to the hospital and then went to St. Mary's. Because she gets confused and she has probably some dementia, they can't have the full rails. So she could very easily get out and fall. My sister spent the whole month sitting in a chair all night long so my mother wouldn't fall. So there's a real issue with caregivers. At one of the nursing homes, one person was in charge of 15 different people. I mean, the ratio is just way off track. So, I mean, I think the caregivers is so important, family caregivers, and the premiums, and so it's an issue. Thank you.
I just want to make one quick comment. Everything that's been talked about home health care, family caregivers, is something that we are on a daily basis discussing with the long-term care industry. Obviously, they sold contracts to you 25 years ago. We can't make them unilaterally change those contracts, but we are asking them to think outside the box here. It makes all the sense in the world to try to get someone, if they can get care in their home, as it's been brought up. Most people want that care in the home. They're happier in the home. It's more cost effective. The patient is happier. The policyholder's happier. We need to start, we are working with them and really pushing them and pushing the buttons for them to start looking into managing long-term care. Now, to the other point that was made, there's certainly right now a significant shortage in certified folks to come into your home to take care of that person. The more qualifications and certifications that we can get in the home, the more services they can provide, will not only keep you in the home, but it's a lower cost to the carrier, which extends your pot of money that you've accumulated for long-term care. So if you have a 5-year benefit plan maximum, if you are in nursing in the home care system for 5 years, you have another 5 years worth of benefit. So you essentially have 10. You've expanded your benefit beyond 5 years. So the NAIC, our insurance commissioner, is committed to forcing them into thinking outside the box, to all the things that were discussed here with regard to home health care and managing the care more properly and more cost effective, and it benefits the consumer at the same time.
Anyone else want to, yeah, Ms. Carrigan. Please.
I come from this from a unique perspective. I got involved in the long-term care business back in the 80s. It was American Express. You probably know it well. I have a policy myself. Yes, you should have one too. My mom is on claim. She's been on claim for 5 years with a policy that was travelers, and there's probably not a week that goes by that I don't get a call from a client complaining about those rate increases. And what I'm concerned about is, the gentleman who said that, was there is an acceptance that this is okay, that seniors living on a fixed income should absorb the mistakes of an insurance company. That is unacceptable. And Senator Lesser, I think you were sitting at the Capitol in 2018 when there was a suggestion to cap the increase. I was like, yes, at last, cap the increase. And what happened is the insurance lobbyists were quoting the insolvency issue. And I really am appalled when you hear that. Does anyone here have pen treaty for an insurance company? Right. Nobody has pen treaty because they went out of business, because their business model, Derek, to your point, is the business model for all insurance, disability, life, is persistency. In 5 years, will the policy holder decide, I don't need this, why did I get this? And they drop it. And they bank that into the cost of the insurance. The mistake that the long-term care market made was they thought it was going to have a persistency of maybe 50. It didn't. It had 97%. So year after year after year, people renewed because they saw their uncle having a stroke or their mom having Alzheimer's. They knew about that in a 10-year window, that persistency was not like life, okay? But they use that all the time. Secondly, the stats that we used as someone who sold it was, you're not getting this to go to a nursing home. You're getting this to stay out of a nursing home. We knew the cost of care. These are not a year benefits, it's a dollar amount. Unlike your health insurance, where you are paying for how much is it going to cost for an x-ray today, we don't know what it's going to cost tomorrow, but you're buying a dollar amount. So it's very different. So what happened is the business model for the Penn Treaties, the American Travelers, the network company that you mentioned was just this. We don't care what health you're in, we're going to insure you. Because when Wynn goes to get a policy and you're on claim, we're going to not underwrite him and we're going to sell him a policy. And it was get as many policyholders as possible to pay for the people that are unclaimed. I worked with the agency that I helped start it was purchased by the Travelers, would never use that business model. So when someone says to you, we have to worry about insolvency, and they use as an example Penn Treaty, American Travelers, or Network, they're not comparing apples to apples. They're comparing a company that was designed to go out of business. They were picking people, and it was a joke in the industry, for those of us that have been in the industry that long. You want to make a lot of money? Start selling Penn Treaty, because they don't care if you're on an oxygen tank, you have Alzheimer's, you have dementia, they're going to insure you, guaranteed. So I hope that it comes back before you, and I sat there, and when I heard that testimony, I cringed. I wasn't in a position to testify at that time, but to hear seniors, and I am now a senior as well, my policy, I purchased it right before I turned 40, was $700. I just paid my premium. It's $1,400 with a guaranteed increase of next year being $1,700. It started with Travelers, it was MetLife, and now it's Bright House. We would say these were lost leaders. Nobody went into the insurance market thinking they were making money, but they got their money selling annuities and life insurance, and it completed their portfolio. So, and I know Matt Lesser and Senator Slapp and Anna, the advocate, I can hear you get it. Enough with the excuses. We need protection. Some legislation needs to happen, and I'm not concerned about the entire United States, but at least in Connecticut, for policyholders like myself and the folks that are here, that every year they're afraid they're going to have to drop the policy as they get closer, because the stats that we used, and they knew it back 30 years ago, was if you live to be 80 years old, you have a 50-50 chance of needing long-term care, not in the nursing home, but at home being cared probably by a loved one that you don't want to burden. I'm sorry to get so emotional, but we need someone on our side, and I know Senator Lesser, you have always been on the people's side. I took a couple notes. I just want to make sure that I covered everything, and that's probably it. But thank you, and I feel good knowing that you're there in charge, quite frankly. Appreciate it.
Thank you, Beth Carrigan, and that was passionate, and I think captures a lot of frustration that people are feeling. And I think when Representative D'Amico likened it to the crash of the financial industry because of these faulty financial instruments 10 years ago, I mean, that resonated with me. That some of them knew that it was bogus and these things weren't on the up and up. Some of them didn't. You can make the analogy that there were incompetent actuaries, but now it's people like Beth and many of you who get left holding the bag. So I get it, and it's not an easy solution, but I feel like we gotta try to do something, because it's not fair, because they got the profits and now you have sunk costs of tens of thousands of dollars over the years. So I want to make sure we have an opportunity for anyone who wants to talk about this, and also some of you might be here for prescription drugs as well. So if you are, we can also have a conversation about that. Want to be respectful of your time. I think we put 6 to 8 too, so we have about half an hour. Of course, I know well, I can speak for myself and my colleagues in the legislature. There were, even after 8, we're happy to continue the dialogue, whether it be over the phone or email or whatever. But
I'm sorry, I go home at 8 o'clock. So.
There you go.
That's your bedtime? That's right.
So if anybody has any more comments or feedback about long-term care insurance, wonderful, come on up. If anybody wants to talk about prescription drug costs and what they're facing, and if anybody has any ideas or feedback on that too, would be welcome to hear about that.
I have a question. Bishop Squatter?
Yes, I will be, yes.
What will you be addressing?
So, right, I do this, we stole the name, Slap Chat, right, because, yeah. So, and I try to do it somewhat regularly, where really just making myself available to folks. So I've done it outside of grocery stores and at senior centers, et cetera. And it's really just an opportunity for me to hear what people are concerned about, get their feedback. So it could be on something like this. It could be on some of the other things that are going on, in the legislature. So.
What time is it tonight?
It is.
Are you serving breakfast?
I won't be serving breakfast, but I think there's usually coffee and some refreshments there. And I think it is at.
10:30 to 11:30 at the West Hartford Senior Center on Stockville Road, and there will be bagels and accessories.
There you go. 10:30, 11:30 at the Senior Center up there in Bishop's Corner, and there'll be bagels. So we can continue the conversation then as well. So thank you, Kate. Yeah. Anyone else want to make any comments? Yes, Judy, for the second time.
I have been fortunate to benefit from the state extra help with medical insurance. I've also been fortunate to get a boost in my income, so I no longer qualify for the level of assistance that I was getting. I still do get the prescription drug help, but I'm right on the edge. And my concern is, well, if I lose that, what's going to happen is I'm going to have to pay so much in prescription drugs that I would qualify for the low income again, except you're not allowed to use medical and drug costs as qualifiers.
Taking your microphone. So I think one thing that the legislature did this year that AARP really fought hard for and supported were, as you mentioned, the changes to the Medicare Savings Program. And one of the pieces that's really important about that program, the governor's budget had originally contemplated adding an asset test to that program. But I think one piece that a lot of people don't necessarily realize is that Medicare Savings Program, the state sort of designed it to take the place of an old program called ConPACE that was a prescription drug assistance program. So the idea there was that if we kept sort of broad eligibility for the Medicare Savings Program, more people could get into that program, and then you referenced eligibility for the federal low-income subsidy, which helps with Medicare Part D payments. So all of that is a really long way to say next budget year, no asset test for the Medicare Savings Program, because it really does help folks. And you brought up another issue that I actually hear from folks about a lot. That's an issue that's come up in discussions around the home care workforce, is sort of the benefit cliff, where people make a little bit more money and all of a sudden they lose a lot of money in benefits. And that's something that I know is sort of in the front of my mind and thinking about, how do we grow and build that home care workforce? Because what I hear now from folks who are in the field is that, because it tends to be a very low-paying work, folks are trying to piece together, 2 and 3 jobs, and a lot of them would be willing to take more hours, but if they did, they would lose their SNAP benefit, they would lose their housing benefit, they would lose, Husky eligibility. So I think that's something to consider, that when you do have good home care workers, are we limiting them and preventing them, through other policies from taking on additional work and additional hours? So, maybe we don't need to grow the workforce. I mean, we do need to grow the workforce, but is part of that growing, allowing people to maximize the hours that they're doing in there and not worrying about, losing $5,000 of benefit for an extra $1,500, well, not 15, but, $200 or $300 of pay.
What we're working on, in addition to protecting the Medicare Savings Program, is trying to find ways to lower the cost of prescription drugs in general. I mean, we pay in this country the highest prescription drug costs in the world, by far the highest. And one of the low-hanging ways we can lower the cost of prescription drugs is by importing safe, affordable, regulated prescription drugs from Canada. There, they cost as little as 10% what they cost here. And other states are moving to do that. And for the first time, although we disagree with the president on many things, the president's been moving to authorize states to do this. And so hopefully we will get that through. It is unclear whether or not those benefits will actually materialize. There's some sign that the drug industry may be looking to restrict exports to Canada as a way of keeping prices high. And then so we're looking at other things as well. So working with AARP and other stakeholders, we're looking at figuring out ways to increase competition. There are all sorts of ways in which the prescription drug marketplace is broken at the moment. One of many examples is this issue of pay for delay. And Anna is actually a great expert on this issue. But the idea right now, the idea that was advanced in Washington was that a company that was investing in an innovative research would be rewarded by getting a patent for a certain number of years. And then that patent would expire, and then generic competitors would come on the marketplace, and they would lower the prices. Well, doesn't quite work that way. First of all, the state is in the middle of a lawsuit against generic manufacturers alleging that they've been in a conspiracy to fix prices and raise them. But second, there is a legal practice that is currently going on where a generic will approach a name brand drug company and threaten competition. And the name brand company will actually pay them money not to compete with them. Now, if you were an owner of a gas station in West Hartford and you paid a would-be competitor not to open a gas station across the street, that would be a conspiracy. It would be a crime. But in the prescription drug industry, that is a legal practice. Now, the state of California just passed a law that in California that is illegal now. I think we should do that in Connecticut 10 years ago. But certainly that's something we can look at this year. And just across our border in Massachusetts, a Republican governor there, Charlie Baker, introduced legislation this year capping generic drug price increases at 2%. Honestly, generic drug prices should be going down, not going up. But that is one simple thing that we can do that would make a difference. A lot of the issues that I'm hearing from are folks who are in high deductible health plans who do in theory have access to coverage, but because of their high deductibles can't afford to access it. And in some cases, as we've seen with the issue of insulin, that is a catastrophic problem because somebody who has to pay $2,500 out of pocket a month in some cases to pay for insulin, they're risking their life. There are folks who are paying more than all of their take-home pay just to pay for a life-saving essential medication. And one of the things I think we're saying, and Derek and I are working on this, we're going to be listing as Senate Bill number 1, a proposal that will cap out-of-pocket costs for insulin so that nobody in Connecticut dies because they can't afford access to that life-saving medication.
Thank you for that. One of the things that is so compelling about this is that even in any other situation, if there is a benefit to be gleaned by the public and there is a private concern that stands in the way of that benefit, we have mechanisms called regulatory takings through which we can benefit the public. Corporations are availing themselves of those tools in order to clear out of the way private interests to benefit corporations that argue that they will benefit the public. I don't want to freeze innovation, but at the same time, how do we resource innovation while taking some of these life-saving medications into the public realm and making them more available? I think that what you're doing is awesome, and I think that we should be thinking more creatively about how it is that we make some of these life-saving medications more accessible.
I'm ready for this part of the conversation. So as much as, kind of referencing back to the long-term care insurance part of the conversation where, there's some solvency issues with these companies. There are not solvency issues with pharmaceutical companies. If you look at their profit margins, you're looking at 18-20% profit for every dollar that comes in. 80% of pharmaceutical earnings every year go to something other than research and development. One of the biggest chunks of pharma money goes back to advertising to you. $6 billion last year. The pharmaceutical industry spent $6 billion with a B dollars trying to get people to buy more of their product. They spent $120 million just on their DC lobbying. That paid for 450 lobbyists to be on Capitol Hill. There are not that many members of the House of Representatives. So they were just, it's a swarm, and we can do things about this. We see other states taking real substantive action on the issue of prescription drugs, whether it's Canadian importation, whether it's drug review boards. Maryland's a good example of that. We're seeing insulin cost caps. Colorado just did that. There's a whole menu of options to choose from. The pay for delay bill in California. The drug industry, and again, thank God for them. I mean, anybody who's ever gotten sick, who's seen their child or somebody that they love be sick, I'm really thankful for those medications. But at the same time, there's no amount of money that I would not pay to keep my child healthy. My son, whose birthday is tomorrow, at one point, as an infant, was hospitalized. They could have come into the room and told me, the drug that's going to make your son better costs $60,000. And I would have said, take my house, take my car, take everything I own. Because our health is not the same as other consumer products. If you can't afford the TV you want, if you can't afford the car you want, you get something different. You wait and you save up. You get the smaller TV. You get the Pinto. You should see the car that I drive. But you can't do that with your health. You can't do that with prescription medication. If I had lunch with one of our volunteers today, who's taking a medication for heart failure. And it was costing her, I think, $460 a month. And at one point she said, I don't have that money. I can't do this. I can't take that. She couldn't have just gone home and taken an aspirin. In aspirin or, ibuprofen, the cheap stuff isn't going to help your heart failure. So we have to not put consumers in a position where they're fighting an industry that has billions of dollars to spend on advertising, millions of dollars to spend on their lobbying. We have to do that. Government has to do that and to play that role and to stop letting people's health take a backseat to corporate profits. This is all a long-winded, I feel like getting hot up here. It's a sort of long-winded way to say, I agree with what Senator Lesser is saying, and I see so much potential for insulin cost caps. New Jersey just passed a much broader cost cap piece of legislation. California has passed cost caps. State after state after state is taking substantive action on the issue of prescription drugs, and I know I'm not going to sleep at night this legislative session until I can see that Connecticut's, moving in the same direction, and we have good leadership on this issue, and we have to get it done, and legislators have to hear from folks that this is a priority and that we're not going to accept anything other than your real full-throated effort at reform on this.
One comment on drug prices and the pharmaceutical industry that you haven't hit on. Not that you guys can do anything about it, but if you go to DC and you say, fix this. I read somewhere, and I could be wrong in the data, but 30% of the dollar cost of the medications, of the high-cost medications, have been funded by you at the National Institute of Health. Researchers down there, then they go and they move to drug company ABC, start up a company, and they create a drug that now costs somebody $3,000 to $5,000 a month to live on taxpayer-funded dollars. That ought to be stopped. You guys can't do it, but maybe the guys in DC can, as dysfunctional as they are. If California can do some of this stuff, maybe you guys can be pioneers and try to copy them in certain ways and try to stop that kind of activity.
Well, actually, there are things we can do. Whether or not we choose to do them, I don't know, but we can do things. So I was down in D.C. for a conference recently, and I met a woman named Dr. Rebecca Gee, and she is the health director for the state of Louisiana. And in Louisiana, as in Connecticut, and in many places, there's a public health epidemic in correctional facilities of hepatitis C, which is a easy to treat condition if you can afford the drug that cures the condition. But the problem is the price of the medication is unaffordable, and yet the research has been paid for by taxpayers. So there is actually a couple of sections of federal law that allow government agencies, including state government agencies, in instances of a public health epidemic, to actually seize the patent. One is called Section 1498, and it allows a government agency to declare an emergency, to seize a patent, to use it, and to manufacture their own drug for purposes of addressing a public health emergency. Now, Dr. Gee didn't actually do this. She just threatened to do this. And then the company that manufactures the hepatitis C drug decided that they wanted to negotiate a more fair approach. And they actually negotiated what's called the Netflix model, a subscription model for Louisiana, where they agreed to just say, you know what, you can have as much of the drug as you want. We'll cap the cost, and you just pay a monthly subscription fee. You know, I think we have a lot of tools in our toolkit that we can use. It's a question of whether or not we want to use them, whether or not the consequences of threatening them are create other consequences down the road. But I can tell you that there are a number of public health emergencies, and there are cases where intellectual property laws are being abused by the drug industry, not to further innovation, not to reward their own innovation, but simply for rent seeking, to maximize profits. We saw that with Martin Shkreli, and frankly, insulin is an example of a market not working. Insulin was invented in the 1920s. It was invented by a Canadian who gave away the patent for $1. It has never been something that needed to be a source of revenue, and yet the price has increased something like 1,000% in the last few years. 3 companies control the marketplace, and it is something that over the last 100 years you would expect the price to go down. It has gone up astronomically, and you know, it is a sign of market failure. And if the drug companies and the industry doesn't respond, I think there should be pressure on those of us who are in positions of power to do something.
Thank you, Senator. I would echo your comments in terms of there are things that we can do, and the question is, will we collectively as a legislature and as a state do them? And, you know, one of the positive things about Connecticut is we do have public campaign finance. We have a finance reform that came about in the wake of the Rowland scandal. And, you know, what it means is that special interests here don't have the same foothold and same power that they do in Washington. And I think that's a really, really positive thing, the way that we elect legislators. So that means that, you know, again, special interests hopefully are not going to become have not become more powerful than you, because that's really what it's all about, is making sure that your voice is heard. Speaking of that, does anyone else want to make sure that their voice is heard prior to us wrapping up our forum? Representative D'Amico.
I don't want to take it away from you folks, but just real quickly, I have a recollection that we did legislation last year. Senator Lesser, I'm going to address it to you, regarding drug prices that drug companies had to justify price increases that exceeded a certain percentage. Did you want to talk about that?
So that actually was 2 years ago, but it's taking effect this year. And so that predates my term as chair of the insurance committee, although I did support it. And that is a new provision that will take effect, I think, in March or April. And that's coming in along. We also just last week with Governor Lamont unveiled what is going to be a new health policy commission. And what we're trying to do is get data all across the healthcare environment whenever prices go up, to understand where cost growth is occurring. And what we're going to do is we're going to set a benchmark for cost growth, because the fact is it's unsustainable just across the whole healthcare space. Inflation and the cost of healthcare is way higher than it is in the economy as a whole, and it's eating up a larger and larger percentage of our national income. We're not going to be able to spend on anything other than healthcare if it keeps on growing the way it is. So Massachusetts a few years ago they set a benchmark for health cost growth, and they applied it just to hospitals. We are going to apply it much more broadly, including looking at cost drivers in prescription drugs, to try to understand where those costs are growing, and then hold hearings if they exceed those. Now, there's no teeth to that, but already in Massachusetts over the last 6 years, their benchmark, they believe, has saved people in Massachusetts over $5 billion just simply by shining a light where people are raising costs faster than they need to. And also, it helps troubleshoot. Sometimes there may be duplication in an area of healthcare. There may be inefficiencies, and just simply getting the whole industry together, from insurance to pharmacy benefit managers to hospitals to providers, getting them all at the same table to sort of troubleshoot why costs are growing has apparently been productive.
All right. Any brave person out there who wants to give us some feedback or questions for the panel? Go ahead, sir.
Is it the state or is it the federal government that will not allow Walgreens, CVS, Rite Aid, etc., to quote you drugs without having a prescription in hand? I'm trying to get, I'm a cancer survivor, so I have some medications, and I try to go to Walgreens. How much does this pilocarpine cost? How much does this ropinirole cost? And they, oh, well, do you have a prescription? No. Well, I can't give it to you.
So if you
I can't get drug prices from a pharmacy without a prescription in hand.
Do you have an internet connection?
I can go to was it GoodRx?
Yes. So if you go,
I know all that stuff, but that doesn't mean that with my insurance card from Aarp, I can't go to their preferred supplier and get a quote without a prescription in hand.
I see potential legislation there, Senator. I don't know.
Okay. We're told Part D is federal, but we'll check it out. That's what tonight is all about. So it's us hearing ideas and pursuing them. So anyone else out there who wants to share your opinions or concerns or anything before we wrap it up? No. This is not a one-shot, so I know I think everyone up here is accessible. So come on up after. I put my cell phone on really everything that comes out of my office, and it's right here, so you can call me anytime or text me, whatever, if you ever have any concerns. I know everyone else, again, is really accessible. So I do want to thank Senator Lesser, Representative D'Amico, of course, Stephen Hernandez, and of course we have Paul and Gerard. Thank you both, gentlemen, very much for coming in and your perspective, and Ann with AARP, and your passion really was. It shone through, and we could tell that you're working. Yes, fantastic. So thank you, everyone, for spending a couple hours with us. And again, we'll continue the conversation. And the timing is really perfect. We start session on Wednesday, next Wednesday, and Senator Lesser, again, chair of the Insurance Committee, chair of the Aging Committee. Representative D'Amico is the House chair of the Environment Committee. So if you have environmental ideas for getting rid of styrofoam or whatever, he's the person to see. I will, just before we wrap up, put in a plug that there will be an aging bill that we have strong bipartisan support for, that is we're going to be a national leader in protecting older folks from age discrimination in the workplace. And when I say older, I mean actually anyone 40 and above is a member of a protected class. And we're going to be closing a very costly loophole that exists, because if you think about it, you go in for a job interview and the person cannot ask you, how old are you? But they can require that information be put on a job application. Date of birth, graduation dates, attendance dates. And so we know our seniors are getting vetted based on their age, based on this information. So I'm really excited for this. Been working with Aarp. The CBIA, the Connecticut Business and Industry Association, is supporting the legislation. We have Democratic and Republican co-sponsors, including both of these gentlemen right here. And we're going to get that done this year. And we have the 6th oldest workforce in the country. So it's not only going to, I believe, make our economy stronger, but it's going to make it fairer for everybody. So I'm excited about that. As well, and I couldn't resist a plug for what's coming along. So thanks again. Have a great night, everyone. Thank you.